Global debt to GDP is now around 320%. And as we've heard in some economies, debt ceilings keep getting raised. Having seen the longest period since the last recession, what are the markets beginning to price in? We're talking now to Simon Popple from Brookville Capital. Simon produces a newsletter weekly from your website. Now, I understand we're getting a preview today of something I know you're going to be talking about in future newsletters about what the markets are beginning to price in. From your seat at Brookville Capital, what are you watching at the moment?
Well, I think it's very interesting. The debt ceiling, for example, in the States, keeps getting raised. And every time the debt hits the ceiling gets raised.
But that's okay. They can do that, surely.
Well, of course
they
can do it.
The markets
but it's a bit like with a child. If you just say that if you're not good, you won't get sweets on Friday. But if you always give them sweets on Friday, their behaviour during the week may not be that fantastic. And so I think the markets are starting to almost ignore the debt ceiling because it's been raised so many times that it's more of a perhaps a guide than a sort of a hard ceiling. So every time we've hit the ceiling, it's gone up.
And debt to GDP, 320%. Why do we care? I mean, it's not costing us anything for this debt.
Well, I perhaps beg to differ a little bit because, first of all, if you look at this graph, you can see that the debt is going up and it's going straight through the ceiling, and gold would appear to be one of the few assets that is not in a bubble. There's a lot of concerns about other assets being in a bubble. But I think the main issue about all this debt going up is obviously the more debt you have, you've got to service it. There's an interest cost on the debt, and if you look at what's happening with yields, across the market, the US, the UK, Europe, there you go. They're all crashing down. Those are the lines that scare me, if I'm honest, because
what does this represent?
This represents the yield on a 10-year bond. So
this is the return investors will get if they go into the bond markets?
Exactly.
Virtually zero?
Well, in some cases...
It's negative.
It's negative. I understand in Germany only 15% of their bonds are actually positive yielding.
So Switzerland is negative on these.
Yeah, Switzerland's already negative, and the US and UK are pretty low, to put it mildly.
Yeah. Okay, so why shouldn't we be interested in this market? And if we're not interested in this market, with what you just said about the rising levels of debt and what's happening with debt to GDP, what is it about the attractiveness of investing in anything at the moment? Well,
it's always good to be diversified. Even though I think gold has got a major case for it at the moment, I wouldn't advocate putting everything in gold. I think you need a diversified approach to life. But what concerns me a little at the moment is that if you look at the sort of tried and tested method, when we have a downturn, people sort of switching from equities into bonds. If you look at the yields on bonds, which we've just seen, they're so low. Why would you want to do that? And I'm not saying you shouldn't do any of that. All I'm saying is you should be considering perhaps a diversified approach rather than moving everything sort of lock, stock and barrel into fixed income.
It's interesting actually when comparing things like yields on stocks at the moment, they are very, very low, and people complain about the fact that dividend yields up to 3%, which is actually very good when you compare it to the yield on the bond markets. But this diversified approach, when looking at your attitude to risk at the moment, are you prepared to hold equities? We've got a lot of geopolitical around at the moment, geopolitical risk. That debt issue, of course, is not just you and I as consumers, it's corporate debt as well that's been taken on. All these things adding up. What sort of spread are we talking about here, and how attractive is gold, which doesn't have a yield, it doesn't produce anything, it just sits in your cupboard and does whatever the gold price does? What are you advocating to your clients about the spread of risk at the moment?
Well, the interesting thing about gold, what you said is absolutely right. But if you're putting money into a bond that's got a negative yield, then with gold, yes, you've got a storage cost, which in a way you could call, let's say, a negative yield, but you still have the chance of price appreciation. And I think at the moment gold is well positioned for the price to move up. And therefore, I think that it makes sense for people to have at least an allocation to gold. As I said earlier, I don't think anyone needs to sort of dive in with both feet, but you should certainly have an allocation. And going back to your earlier question about equities, I mean, they've surprised the hell out of everyone. They've kept on going up. So it makes sense to be diversified. But I think that a lot of people have ruled gold out for whatever reason, and they now should seriously consider having at least some in their portfolio.
What about central banks? I think of two things actually. First of all, we've spoken about this before about central banks buying gold, and we hear that quite a lot in the emerging markets. So I'll ask you that question as to whether or not they're continuing to do that. But other central banks are pumping money into the markets. We're not seeing that in the States anymore. They're doing quantitative tightening. But we're hearing words now from the European Central Bank. They want to get back into handing money out again. And that's another reason, isn't it, to stay in risk assets rather than gold?
Well, it's initially I'd agree with you, but I think that the whole system is built on trust, and you can print money initially, but I don't think you can print it forever, and therefore people, yes, they do want to have some money in risk assets, like equities, but I think they should look at other things as well, and gold is at the moment very, very topical as another asset class.
And how much of, let's take a look at the gold price, how much of this gold price is being twisted by those emerging market economies that are buying gold? Are they still buying it at the record levels that we saw when we last spoke a couple of months ago?
Yes, I mean, Russia and China in particular, are buying a lot of gold. Exactly why they're buying it, I don't know. But there would appear to be a slight sort of path to safety where they are, again, just as I've advocated, they're diversifying the basket of assets that they're investing in.
Yeah. Just want to return to the gold price and talk about your allocation in terms of how you're taking advantage of what you perceive to be an improving market. I mean, I don't know whether you have a price target here. We're talking here about 1,393 the ounce at the moment. Is it bullion? Is it coins? Is it stocks? Is it ETFs? What are you buying?
I think it makes sense to have a bit of everything, to be honest. The gold price, it could go up significantly. I've heard talk of 1,600, 1,700 in the next 12 months. But if you buy the mining stocks, then you get the leverage because it's unlikely costs will go up by the same amount as the price of gold. So the mining stocks, their margin increases significantly with an uptick in the gold price, and or should do. And when that happens, obviously, the share price will move up. And if you look at what happened in the 70s, some shares just went up dramatically.
Yeah. Okay, all right, so look, Simon, it's a pleasure to catch up with you again. Thanks indeed for joining us. And just a reminder, you can catch up with Simon on his website, Brookville Capital, and his regular weekly newsletter